Well, thank you very much, George, and I really appreciate all of the long list of credentials. It's nice to speak at a university where your credentials are rolled out in total. And that really leads me to my first point. I think in the investment business, people will be mildly interested that you finish out with an MBA from Western, but the prevailing attitude in the investment business among your clients will be, so what have you done for me recently? And so with that thought in mind, I thought I'd better go back and see. Last time I was here was almost exactly 2 years ago, what I said back then, to make sure that I did in fact provide value added to George's class. And I was pleasantly surprised, you can imagine. Obviously I wouldn't be bringing it up if it hadn't looked quite favorable. In fact, I'm surprised that George is still having to work for a living here, because the first suggestion, or illustration, these are not recommendations, these are illustrations, was one which was so successful that in fact we use it in our marketing for the Saxon funds. And it was a company headquartered in Kitchener-Waterloo. In fact, on my way here 2 years ago, I visited this company. It's called Vertex Vision. And they're a laser-based company. They use them for cutting and marking and making templates on the ground. And when I was here almost exactly 2 years ago, that was March of 08, the stock, you'll see, was trading around 40 cents. And before the year was out, it was taken over for $1.05. As I say, this was an interesting example, and I'll come back to this in a moment, that most value investments don't work out this quickly. It was a takeover situation, as I say. I was using it as an illustration. I'll tell you what the formula or the equation was that I used back then, because I'm sure you're thinking, well, that's nice, but it's ancient history. You know, what are you going to do for us today? So I do have a couple of examples for you shortly. And round about 40 cents, round about here, I got a call from the Ontario Securities Commission Enforcement Branch, which is kind of scary, you can imagine, because if you're an investment counselor, you have to be registered with the Ontario Securities Commission. And they wanted to know what we were doing buying this stock. And they thought we must have inside information, which is a bit of an insult. You know, if you're a value investor and you found something that you think is an undiscovered opportunity, and the regulators call you and assume that the only reason you would be buying it was because you had inside information. As I say, I found that a bit insulting, but I was able to brush them off. Anyway, so that was Vertex Vision. It had a certain technology content, but that was by chance. It was a true value stock, and I'll explain, as I say, in a moment what the formula was. The other one was less auspicious, but fortunately, if you go back, you can see I was a little more lukewarm on this one. In fact, this one had almost similar profile, and it was Liquidation World. And let me see if I've got this the right way up. Yeah. And again, back then, it was around $2, and now it's bumping along below $1. It was similar kind of characteristics, but as I said back then, and the evidence is there on videotape, I said maybe this is a value trap, which is the other half of value investing, and I'll address that as well as we go through. Maybe this is a value trap. In fact, I said back then this was a much bigger class for whatever reason. I said that maybe the best way we'll get out of it is that everybody in the class goes down to Liquidation World at the corner of 401 and whatever it is, Wellington or Oxford, and spends big bucks, because I thought that might be my only way out of Liquidation World. And in fact, you'll see it's just dribbled away. And in that intervening time frame, we actually have a new board of directors. We have a new management team as well. They're hot shots in the liquidation business from Chicago, and even they haven't been able to turn it around. So the message on this one, I guess it's twofold really in the messages. One is, even if you're convinced you've found a great value stock, it's a 50-50 chance it will be Liquidation World and not Vertex. So be sure to be reasonably diversified. And so there we are. As I say, two stocks. One worked out well, one worked out badly. And but when you buy them, if they're a value stock, they all both look, within reason, equally attractive. And so what was the characteristic of the magic formula, the equation that I used to identify both the Vertex Vision and the Liquidation World? And the calculation that I go through is one that you can call, I call it net collateral value per share. And it's a sort of a variation on the Venn Graham net working capital. And it's called collateral value per share because I start out with the assumption or the question, what would a banker, a reasonably friendly banker, loan you against the collateral value of your assets in the business? And so if you think about it, bankers will always lend you money if you don't need any. So the starting point would be if you have any cash and short-term investments, then that's worth 100 cents on the dollar in terms of collateral. If you have accounts receivable, some of them won't be paid, some of them they drag their feet, but a banker probably would loan you 75 cents on the dollar against your accounts receivable. For inventory, well, it depends what it is, obviously. If it's liquidation world, I mean, one of the attractions to liquidation world was it was trading below its liquidating value per share. And so you say, hang on a minute, these guys have inventory that's already priced at liquidation level, and I'm buying it at a discount to liquidation value. And so for inventory, we assume 50 cents on the dollar. So you extend that out on the balance sheet. Fixed assets are now a little difficult, particularly when you're doing an initial screen, because at this point you don't have the time to go through and look to see how much is land, how long have they owned it. You know, if it's a retail company, their fixed assets are probably just coat hangers and leasehold improvements. So you have to come up with some sort of approximation. And so we say 100 cents on the dollar for the net depreciated fixed assets. And so for some companies that will dramatically understate it. If they've been in business a long time and own their own property and plant, clearly it understates. If they, as I say, if they're a retailer, it maybe overstates the fixed assets, because if you walk away from your leases, you don't go back to pick up your coat hangers. But anyway, so that's the left-hand side of the balance sheet. That's the collateral value of the assets. You go over to the right-hand side of the balance sheet now, and you just look for interest-bearing debt. Because don't forget, we're dealing with a banker here. And if the banker decides to call your loan on their interest-bearing debt, they don't care about all the accounts payable and all this stuff that's not secured, because they're going to get stiffed, right? When you walk away from your business, the banker has interest-bearing debt, but the people who don't have any collateral are out of luck. So you just look for interest-bearing debt, and you deduct the interest-bearing debt, if any, from the collateral value of the assets. And then you now have what I call the net collateral, or the net liquidating value per share. And so you divide that by the number of shares outstanding, and now you've got the net collateral value per share. And what we're looking for is stocks where the stock price is below the liquidating value per share. Because essentially the stock market is saying these guys are worth more dead than alive. So if the incumbent management isn't capable of doing anything to turn it around, maybe someone else will come along and either liquidate it or turn it around and at least have a fighting chance to create a profit for you. So that was the simple, straightforward. It's a very easy kind of screen. Well, it's easy for me to describe, and you had to tinker a little bit if you have Bloomberg or a database. But you do 100 cents on the dollar for cash and short-term investments, 75 cents for accounts receivable, 50 cents for inventory, and you can decide, but as I say, we use 100 cents on the dollar for fixed assets, deduct interest-bearing debt, and you've got the net remaining. So that looks pretty good. And so I'm sure you're thinking, so what's on the list today? Because this is ancient history. Liquidation world is just bumbling along. Vertex Vision was taken over completely. So actually I ran a screen on our Canadian database, and I hope this is legible. And this is a company. It happens to be in Kitchener-Waterloo. I think there's a message coming up here. It happens to be in Kitchener-Waterloo. And let me just find it, because I have Daniel. Here it is. We're out of order. And it's called RDM Corporation. And I left my little handwritten scribble, because that's how you do things in the real world. You just get an annual report, and it's come up on the screen. And in the old days, you'd have to actually send off and ask you to mail them an annual report. Now you just type at CDR, and it pops up there on your screen. You print off the relevant pages. And so here's this company, RDM Corporation. It's headquartered in Kitchener-Waterloo. They make remote, image capture equipment. It's mainly used in the banking industry. And as you probably know, with banks, if you pay by check, your check with the signature and the endorsements, if any, on the back, has to come back to your bank to be approved before it goes out of your account. And that's a lot of stuff to be moved backward and forward across the country, particularly in the United States, where they have so many more banks. The number's diminishing, but they still have, I think, about 8,000 banks. And so these guys have a very high security image capturing system that permits the banks to say, we will take a visual image or a photographic image of the front and the back of the check. You can send it to us remotely or electronically, and we'll use that. We don't have to wait for FedEx or Purolator to bring all these stacks of checks to us. So you can see this is a business with reasonable opportunity. You can see it requires a little more security associated with it than just simply making a photocopy of it and emailing it. And the number of checks that move around the country every day, clearly you need something that has the ability to handle volume. So that's the business that they're in, and here we are. So
what was the screen you did?
the screen was the collateral value screen, the one I just mentioned, the liquidating value screen. So and I'll show you I described the screen, but now I'll show you how you work it out. You say cash and equivalents. You'll see it's very faint there at 100 cents on the dollar. So that works out to 78 cents a share, because the number of shares outstanding here is 20.8 million shares, right? So I've done cash and equivalents at 100 cents divided by 20.8 million gives me, 16 million divided by 20, it's about 80 cents a share, okay? So right away that's interesting, because the stock price is only 90 cents a share. So you got 80 cents a share in cash. Accounts receivable, 4 million times 75 cents, 0.75 divided by 20 million, and that's worth 14 cents a share. Inventory, they got almost $3 million at 50 cents a share, so that's 1.5 million divided by 20 million. Where are we now? 7 cents a share. So you go down the left-hand side of the balance sheet, furniture and equipment, 100 cents, that's the net furniture and equipment at 100 cents on the dollar, and that's worth 15 cents a share. So the sum of all of these collateral asset values is $1.14. They have no interest-bearing debt. They have some payables, presumably to the landlord and to the suppliers, the guys that provide the juice in the employee cafeteria and stuff like that. That's the payables, but they're not interest-bearing. So we don't deduct anything from that. So we have $1.14 per share of net collateral value, because there's no deductions. As I say, the stock price is 90 cents, so here we have a company which is trading, as I say, below the liquidating value per share. More conventional calculations, book value per share is the 26 million divided by 21 million, so that gives you $1.27. The traditional Ben Graham net working capital per share, which is not very different from our computation. We give some value to the fixed assets, and we mark down some of the current assets, but essentially you often come up with a similar number. Net working capital per share, $1.11, and the collateral value per share is $1.14. So, as I say, there's a message here. They too are in Kitchener-Waterloo. They too trade below collateral value per share. They seem to be a reasonably technology-oriented business. You know, they're not making shoes or clothing or something where you say, this is a dying business. And in any case, you get almost 80 cents a share in cash. Not exactly for free, it's an operating business, but clearly they're not going to have any short-term worries about meeting the payroll. The stock itself has not been a stellar performer, as you can imagine. That's how you get to be on that list, by the way. When you're looking for screens of stocks that trade below collateral value per share, you don't expect to see any high-class companies. You're not going to find Shoppers Drug Mart. You're not going to find Canadian Tire. You're not going to find well-known large-cap companies, under normal circumstances anyway. You're going to find obscure little companies where there's kind of hair on them, and where probably there's a large number of shareholders who are and have been disappointed for some time. Here's where it peaked back in the end of 2006, early 2007. And so you can imagine why 3 or 4 years have passed. Presumably company management have disappointed investors. Their quarterly earnings and revenues maybe have been below expectations, which was the problem if you've been paying, what was that, almost $6 a share. Because at $6 a share, there's no margin for error. I mean, these guys have to deliver. At 90 cents a share, you might be inclined to say, I don't really know. It seems like a legitimate business. The management seems to be halfway competent. And if I can come up with 20 or 30 stocks like this, remember, don't bet on 2, but if I can come up with 20 or 30 stocks like this, then over time, good things will happen. I don't know specifically what will happen. I mean, Vertec was just I was going to say a lucky break. It got taken over very quickly. And that is unusual, but it wasn't a lucky break, because actually I met the management of the company that started the takeover offer at a conference in the US, and I said they should have a look at Vertec. And I just simply told them, the great values that were there, and they were all over it. And they opened up the bidding, I think, around 70 cents. And so clearly there are things you can do to speed things up. But here you've got a very similar situation with a legitimate technology, legitimate company, and lots of cash, and clearly very disappointed shareholders. Yeah.
Just on the initial screen, you mentioned that it's a technology thing like this, but how do you think about the business as a whole? I'm assuming they're losing money currently. So that shows the balance sheet, but how do you think about the company as a whole? I'm assuming is losing money. How do you think about that risk if few years down the road, even if it is a technology.
Yeah. Yeah, the issue in terms of cash flow is an important one, because you're quite right. This, like many of the Ben Graham analyses, focuses on balance sheet. And you're right, if you're losing money at a rapid clip, then that money is gone. And some businesses appear to be initially attractive. Biotech is a good example of that. And they have an expression for biotech which is called the burn rate, because they raise a lot of money on the basis that they're going to come up with a cure for cancer, and then they start spending it. And they have a whole lot of PhDs in labs. And so you just simply look at the rate at which they're spending, the so-called burn rate, and divide that into the cash and say, they've got 2 years, they've got 3 years, but if they don't come up with a cure for cancer within 3 years, we're history. And what happens with biotech stocks usually is that the price, after the initial enthusiasm has evaporated, the price tracks pretty closely to the remaining cash. And then when they get down to the last dribs and drabs of cash, then they have to raise money again, and now they're negotiating from a position of weakness, because everybody knows they've only got 6 months more cash, and they still don't have the cure for cancer. So, cash flow break even, I'd say, is probably a minimum requirement. And these guys are round about there. They don't have to be, because if they were superbly profitable, the stock wouldn't be on the list. I mean, this is the yin and the yang, or whatever the right expression is. You say these are really interesting, intriguing value opportunities, but they're a bunch of dogs. And so now you have to decide, how am I going to analyze the entire list and buy my 2 or 3 favorites? I say that's not the right approach. Or am I going to just buy the entire list and say, look, this is as much analysis as you need to do. And if I do more, I'm just as likely to own the losers, and reject the winners. And so this is a perennial, balance that you have to do. In fact, my next example is a good example of a problem where you have something that's statistically cheap, but has an issue that's very common in Canada, where you have people with multiple voting shares. So you're not going to get to control the business. This is Danier Leather. And the collateral value, again, on the left-hand side, you'll see they got lots of cash. Actually, they have lots of cash because they were sued when they went public. And they kept the cash because they kept losing the lawsuit. Yeah.
Just a quick question. For your net collateral value per share, do you include intangible assets?
No, there's no value given to intangibles.
For companies such as the one before RDM, shouldn't there be some sort of value attached to it, because these patents could be sold?
In theory, yeah. I'll come to that in my next iteration, because my next iteration will be, so most of the companies on this sort of screen right now are tiny in terms of market cap, and they're marginal companies, and they're not really big enough for an institutional portfolio. And so if you're willing to own a little, if you're willing to pay a little extra for growth or for intellectual property, then, how do we tackle that? So we'll come to this shortly, but at this stage we're just saying this is the knockdown value. This is the bare bones value of the company. No value given to intangibles or what have you. So they've got a lot of cash, because in the final element, as I say, they kept losing lawsuits, so they kept building up cash in case they had to pay out. In the end, they won in the Supreme Court, so the accrued liability that they had went away, and the cash is all theirs, the shareholders, that is. So that's why they've got almost $30 million of cash. At 100 cents on the dollar, you see the value there. Accounts receivable at 75 cents, same process, 75 cents. The inventory is at 50 cents. Now, that's a lot of leather jackets. When you get into retail, I know if 50 cents is the right number, because if they go belly up, you think, well, if Danier couldn't sell all those leather jackets, why do I think I could or somebody else could? But that's why we mark them down to 50 cents, I guess, just to be conservative. Fixed assets, well, they got 17 million, although again, as I keep saying, retailers are mainly leasehold improvements. They do have a plant, I think, in a factory somewhere on St. Clair Avenue West in Toronto, so maybe some value there. So maybe we're being a little generous there as well. Again, they have no interest-bearing debt, so we got nothing to deduct from the collateral value. So their collateral value is 65 million. The number of shares outstanding is a little shy of 6 million, you'll see. So the collateral value per share here is $11.12. You see that? That's essentially the 60-odd million divided by 6 million shares. The book value, the tangible book value per share is $10.25, and so the stock is around $6.50, $7. So on the face of it, it seems to be pretty cheap. In fact, it may be even cheaper, because subsequent to this quarter, they did what's called a Dutch auction, which is a relatively unusual phenomenon, but they essentially say, we will use some of our cash to buy back shares in the market if you choose to tender. And so the thing about the Dutch auction is that everybody says the minimum price they would accept for their shares. And the company, in its turn, says this is the maximum amount of money that we're willing to pay in cash to buy back shares, and this is the maximum price that we'll pay. And so the solution really is where those two intersect. And so people, if they choose to tender, they may say, I'll tender 500,000 shares at $6. And someone else may say, I'll tender 20,000 shares at $6.25. And the company adds up all of the shares that have been tendered, and everybody gets the highest price that's within their parameters. And so I guess it's fair, because if you said, I'd be willing to tender my shares at $6, and in fact you get 6.25, then you're pretty happy. So the theory is everybody's happy. They get at least what they asked for, or maybe a little more. And so that's what Daniel and Leather did during the first quarter. So actually now there are far fewer shares outstanding. They used some of their cash, don't forget. They used 6 or 7 million of their cash to do this buyback. But there are now fewer shares outstanding. There are now only 5 million shares outstanding, 4.8 million. So those numbers have all gone up. After this Dutch auction, the book value is now 11.50, and the collateral value is 12.25, and the stock is still around 6.50. So here we got a company that on the face of it is just incredible value. I mean, it's half of its collateral value, half of the liquidating value per share. There's just one fly in the ointment, I guess. Anyone want to guess what the fly in the ointment is that's not unusual in Canada? I mean, why isn't this irresistible? Jeff?
Did you just mention the dual-class share structure?
Dual-class share structure, yeah. The Wertzman family own 1 million or so of these 5 million, and they have 10 votes per share. So unless the Wertzman family decide that they're either going to liquidate or sell out to some bigger firm in the US or whomever, you're not going anywhere. And so, yes, this is statistically cheap, but you just have to decide, am I willing to wait for their timetable? And then you might want to go out to the annual meeting and try and figure out, how old does Jeffrey Wertzman look to be? Does he look as if he has kids who might want to be join the business? Is there dissension and dissent among the Wertzman family? I mean, there's a whole lot of things that are nothing to do with investments and nothing statistical, but you might be willing to do it because there are lots of Canadian companies that are family-owned. Many of them are not taken over, but I can think off the cuff of Black Photo, Irwin Toy, Cooper Canada are all companies that were Canadian, family-controlled, and the family members, for whatever reason, decided we're willing to sell out. So it can happen. You wouldn't want to be in a high-priced stock, obviously, hoping for that to happen, because you just, if it doesn't happen, you got a long wait. But in a low-priced stock, maybe. You may decide that a small part of your portfolio, it's worth taking a gamble, not on value, because the value is clearly there, as long as people keep wearing leather jackets. That's another problem, actually. Maybe it's a bad industry, because how many people have a leather jacket? Okay, everyone, okay. So the market share is pretty strong. And how often do you replace your leather jacket?
Well, we valued this a few years ago, and I don't remember the price was $575, something like this, and it was a buy.
Yeah.
And I was thinking, should I buy, should I not buy? And I said, okay. I've never been in this stores, okay? So I take my wife and I say, okay, let's go in the store.
Yeah.
Oh, what's the point? They look really nice, really nice jackets.
Yeah.
But when you put them on, it don't fit well.
Yeah. 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 Well, that's the good and the bad news about retail. Everyone has an opinion. Yeah.
Do you ever visit the stores and around?
Yeah, well, one of our favorite stocks, you can imagine, that we owned for quite a while was La Senza. And so I was always hanging around the women's lingerie. And it worked out very well because it got taken over by what essentially is Victoria's Secret. We also own Future Shop. And those are two good examples, actually, again, of the Canadian phenomenon, where both of those could have worked out badly, because in the case of La Senza, there was always a worry that Victoria's Secret might come into town and we'd be toast. And instead, we were lucky because I guess they had good locations at the major malls, the Yorkdales and the Sherway Gardens, the fashion-oriented malls. And so Victoria's Secret, their limited brands, I guess, thought it was better to take them over and hit the ground running. And so were we lucky? Well, again, we had a diversified portfolio and it was statistically cheap. In the case of Future Shop, we were always worried that Best Buy might come into town and blow them out of the water. And in fact, we were lucky again because Best Buy decided to buy and keep the brand of Future Shop. So those were two situations where we visited the stores, but in a way, our opinion of the stores was almost irrelevant because bigger things were happening there. One we've been looking at recently is American Apparel, where you go in the stores and it's tough to figure out quite what the attraction is. The CEO is Canadian, but is perceived to be kind of wacko in terms of his management style. And so, you have to decide with retail, just because you wouldn't shop there doesn't mean to say that it doesn't have appeal. But back to your example, my wife agrees. She thinks that Danier leather product is not particularly attractive or well made, not particularly good quality. But each one has a price point. Le Chateau is a recurring retail company that shows up on value screens. And again, you may say, well, that's not, my age group or my price point or whatever, but you've got to, put that out of your mind. I know Peter Lynch, one up on Wall Street, says he used to go to the mall with his teenage daughters and see where they were shopping. And there's some benefit to that, but there's also the heuristic of, hindsight bias. You remember the winners and not the losers. And so statistically speaking, whether or not it adds value, I'm not 100% sure.
And for me, another negative, I guess, was one day I looked where it was made.
Yeah.
It was made in Turkey.
Turkey? Well, okay. Yeah. Well, that's a legitimate bias, but I'm not sure it has any investment content. Yeah, you're quite right. Retail is a tough business because everybody has opinions on what you should be doing, or what you could be doing better. And that may not have any bearing whatsoever on your investment decision. And the same with technology. If you don't understand the technology, you tend to think, oh, it must be sophisticated and therefore worth more. But I think Bill Gates had it right when I think he must have come back from a lunch with Warren Buffett, because he said Microsoft, he thought, should trade at a lower multiple than, say, Berkshire Hathaway. Because if you're in the technology business, like Microsoft, he said, for sure we'll have 2 or 3 crises over the next 5 or 10 years. He didn't know what they were, he couldn't specify them. But with technology, things happen. They're completely different solutions, your stuff obsoletes. Blockbuster, you can imagine, is no longer leading edge in terms of distribution of video content. But video content will continue to be distributed. So technology, maybe instead of paying a premium PE multiple, you should actually demand a discount PE multiple, which is why RDM, at 90 cents or whatever, and a discount to collateral value, you may say that's a worthwhile investment. At $6, you had to know all about the U.S. banking system and how quickly checks are being, taken out of the system, and what the alternative solutions are and who else is in the business. You need to know a lot of stuff, and you have to be right. And that's tricky. Lots of analysts know a lot of stuff, but being right is a little more complicated. So that, as I say, is Danier leather, and that would be more typical. Not often do you come across a statistically cheap stock where everything seems to be going right for them and they have, proprietary position, dominant market share, and smart management. Because if they have all of those things, they're not going to show up on your value screen. So let's assume, though, and right now it's not an assumption, it's a fact, that the current environment, the current universe, when you do this kind of screen, you only get a page or so, and there are a bunch of small companies, market caps, less than $20 million, which I think Danier is a little larger, but RDM is less than that. Certainly Liquidation World, I think, is maybe 12 million. So if you're working for a larger organization, or if you're willing to say, well, I'm willing to pay up a little bit. I mean, these stocks that I'm looking at, these are bad companies, and I'm willing to pay for legitimate, what would you call it, intellectual property, patent protection, things of that kind. So how can we graduate, as it were, from poking around in the undergrowth for these deep, deep value stocks to a situation where we say, okay, I'm willing to pay something for sustainable growth. And so if you had to think of a ratio to calculate to determine what would be at least the sustainable growth of a company, what ratio would spring to mind? I mean, there's masses of accounting ratios you could calculate, debt to equity, current ratio, whatever, but they don't have anything to do with growth. So what is the sort of the central tendency around which companies can sustain their growth rate without having to, go to the financial markets on a regular basis.
So, well, the return on their assets over their cost.
Yeah, essentially it's the return, the profitability of the business. Return on equity really is the simple ratio to calculate right out of the starting gate, because return on equity determines your internal, growth rate, or more specifically, ROE times 1 minus the payout ratio, the retention rate. That's essentially the upper limit of how quickly a company can grow organically. And so ROE, I think, is the starting point for any kind of growth calculations you want to make, regardless of the nature of the company. And so we're coming closer and closer to how do we handle, intellectual property and stuff like that. So why do I like ROE? Well, ROE is, as I say, the starting point when you're calculating ratios, particularly now, of course, with computers, and particularly if you have access to a Bloomberg, the ratios are all calculated for you. So many people say, well, I don't know where to start. I mean, I've got thousands of ratios. I don't know where to start, and I don't know what questions to ask to sort of drill down. So I think that, as I say, the return on equity is really important because it determines your future growth rate, organic growth rate of the company. And that, in turn, can be broken down with the DuPont formula. And that's, as it says here, the return on equity is a function of your asset turnover, your financial leverage, your pre-tax margin, and your tax rate. And so you can look at companies' financial ratios, I guess it will be longitudinally over history, or else latitudinally to compare them to other companies to see how do they stack up to other companies. And the return on equity, if you look at it longitudinally, for many companies will fluctuate. Obviously it's not, comes in as clockwork, the same number every year. And what you're interested in with the DuPont formula is saying, what are the variables that are tweaking this ROE as it changes from year to year? Which of these elements? Because some of them will be pretty stable, and you can say, okay, for my first cut, I won't calculate any more of those ratios. I won't be asking questions about that. These are the critical ratios for this particular company. And for each company, it may be a little different. And that's the whole reason why you do, as I say, the DuPont formula. So I brought some samples of DuPont formula. And what makes them more interesting, I think, is if you don't know what the company is when we start, because then we can make some observations about what makes certain industries tick. So this one's Company A, and if your eyesight's good, or even if it isn't, you can just see the characteristics here. These are the DuPont formula for the last 10 years. And you'll see the left-hand column is the return on equity coming through for the last 10 years, and that asset turnover, pre-tax margin, tax rate, and financial leverage. Financial leverage here I define as total assets divided by shareholders' equity. So if it's not equity, you borrowed it somewhere. Maybe it's for payables, maybe it's real debt, but it's borrowed somewhere. So a higher number is more leveraged. And you'll see this company back in 2000 earned, and in the early years of the 2000s, 20, 22, 24% return on equity. Pretty stable. Asset turnover was up maybe 4 times, so that's also fairly stable. Pre-tax margin, fairly modest though, around 4%, and that's pre-tax margin. So the after-tax margin's maybe 2%, not much more. So this is a pretty low margin business. The financial leverage, you'll see, that wasn't too bad. 2.2 is not unreasonable for a Canadian industrial company. So you'll notice also, where are we now? In 2005, we have a big jump in the financial leverage from 1.8 to 2.6. And the asset turnover drops, and the ROE drops, and they're slowly kind of clawing their way back up to the levels they were before. So based certainly on the numbers for the early 2000s, what kind of company does this seem likely to be? You got high asset turnover, you got low margin. Yeah, a supermarket, yeah. This is Metro stores. Yeah, low margin. High turnover, because every week you go in to buy your yogurt and your milk and your orange juice and stuff, so you'd expect the asset turnover to be high and the margins to be low. And in 2005-06, I forget which year exactly, they acquired Dominion stores, which they've since converted to Metro. So that's why the financial leverage made a jump, and the asset turnover dropped, of course, because they got all of the assets before they got the revenues running for them. So if you got a chance to go visit the management, the CFO of Metro stores, you'll probably be interested in, the ROE, of course, is lower now. I mean, you're interested in, can you get back to the levels you had, 10 years ago? And the big variables are going to be asset turnover. They're a bigger firm now, maybe geographically they just, this is the best you can do. If you were smaller and focused, you can turn your assets. Now, maybe if you're national, you got a bit more of a problem. And the pre-tax margin, well, they've pretty much got the pre-tax margin back to the previous levels. So I think if you, as I say, got an interview with the CFO of Metro, your focus probably would be about logistics and asset turnover and whether or not they can do on a national scale what they seem to be reasonably successful on a regional scale. So that would be, as I say, a good way to start digging a little deeper. You'd know of all of the ratios in the universe, the logistics ones, the asset turnover ones are ones maybe where you want to dig in. The financial leverage is now back to the level that it was, at the beginning of the decade, so that doesn't seem to be a cause for concern anymore. So that one's pretty straightforward. It's quite stable, and again, you'd expect that because the supermarket, you go back every week to buy recurring purchases, and so why would there be great fluctuations? So naturally, the next one is all over the map. This is company B, and you see the return on equity in the left-hand column. Sometimes it's 60%, 68%, sometimes it's minus 74%. It's all over the map. So obviously there's some very, very different environment here. The asset turnover was low and remains quite low, so whatever it is they're doing, they aren't turning it over very rapidly. The big problem they have is their margin. Sometimes they lose money hand over fist. Sometimes they rake it in. The financial leverage is somewhat lower than the supermarket chain. And you'd think, well, that might be necessary because if you have a business that fluctuates so much, nobody in their right mind is going to lend you any money. So you're going to have a lower financial leverage. So any guesses as to what kind of company has a margin that goes from minus 30 to plus 30? Yeah, Liz.
Something more on the high-tech side or the biotech?
Well, it could be. In fact, we have an example of that. What else is cyclical? Because that's cyclical. They have big winners, they have big losers. What other industries have?
Resources?
Yeah, this happens. This is Breakwater Resources. They are big. Well, they're not that big. They're a small cap zinc producer. And so they don't have any control really over the price of zinc. It's just whatever. And so they're price takers. They have relatively high cost mines in BC and on Vancouver Island. So they can do their best to try and get costs down. But there's a limit to what they can do there. And so that's when margins get squeezed. And they, I think, were financed by Dundee Corporation back in the early days because otherwise they probably wouldn't have survived. So they kept doing issues of additional shares, additional warrants, just to keep them going. And that's why they're able to survive. And you can see that the ROE calculation maybe isn't going to be very helpul here. I mean, you calculate it, but you say, I would say, I don't have a clue what questions to ask. Well, they're big picture questions. What do you think will be the price of zinc? What's the London Metal Exchange inventories? A whole lot of stuff that Breakwater can't answer. So in fact, if you were going to invest in a company like this, you might spend most of your time looking at the industry environment and only a little bit of time actually analyzing the company. This happens to be the most leveraged Canadian zinc play you can get. So if your big picture thesis is favorable to zinc, then you probably just do enough homework to make sure that Breakwater can survive for the next fiscal year and say that's all I need to know because so much of it is out of their control. The next one, Liz, is in fact, where are we? Company C, high tech, because they have somewhat similar characteristics. They go from boom to bust. You'll see the ROE is minus 65%. That obviously isn't sustainable. A couple more years like that and there won't be any shareholders around. The financial leverage, you see, used to be very, very low at 1.1. It's now somewhat higher. But again, people don't like to lend money, interest-bearing money, to high-tech companies, certainly not when they're relatively small. The asset turnover is quite low. The pre-tax margin is all over the map. Most recent year, you see a negative 94% pre-tax margin. It looks like they're putting a $10 bill in with every software package they send out because how can you lose 94 cents on the dollar of every revenue? And this is CryptoLogic. And so they do software for companies that want to run online and internet gambling. And so every now and then, mainly the U.S. decides that this is illegal. And so they close them down or close down their customers. CryptoLogic doesn't run the internet gambling. They run the software for which you can use for casinos and internet gambling. So again, this is one where maybe you could come up with some judgment as to the ROE, but more difficult. And the final one is, again, very stable. You see the return on equity always in the mid to high 20s. The asset turnover astonishingly low. That's the 0.07, 0.08 line, column rather. The pre-tax margin is pretty impressive there, from 22 to 40%. Tax rate is legitimate, around 27 to 30%. That's pretty normal for a Canadian company. The financial leverage, though, is is a very different number from what we've seen previously. Okay, so we've got the handle on that. Yep. Financial institution. Yeah, with that kind of financial leverage, you have to be a financial institution. Even more, maybe you could be a public utility, but really you have to be financial. But look at those pre-tax margins. So who do you think they're lending to? Yeah. No, corporates have choices. This is home capital. They lend to people that can't borrow from the mainstream chartered banks and whatever. So they say, and I mean, they've been doing it. It's like Stella Jones. I mean, I read the words, but I can't believe it. They say that Canada is full of entrepreneurs that don't have T4 slips and T3s, but they're good credits. And so they can't borrow at a traditional bank and whatever and get the loans at prime plus one or whatever. They have to go to home capital, and they borrow for mortgages, and I guess mainly mortgages, some commercial applications as well. And so one thing is really noticeable if you look at other companies in this industry that are lending to, I guess you would call them marginal borrowers. It's a very profitable business. The default rates are far lower than you would imagine. I mean, you would imagine that you'd have 20, 25% default rates. Astonishingly low. I mean, they're not the fraction of 1% that a chartered bank gets. But when you consider how much extra they charge, I mean, it's like charging credit card interest rates for your entire portfolio, as opposed to the banks that just charge it on their credit card portfolio. So this is, if there's a business you want to get into, this is definitely is one to look at, is loaning to what you call subprime individuals, if you do it properly. Obviously, the U.S. was an experience where they didn't do any homework. But home capital, clearly, do their homework, they do their credit checks, and they have a higher than average default rate. But look at that return on equity, 28%. And right through, was there a recession in Canada? I don't think so. Look at those numbers. The ROE was spent straight through. Okay, so we have now some idea about what ratios we're going to calculate to figure out what the return on equity could be. Because if you look back, 10 years is probably enough. More than 10 years, and that's before, probably have different management. It was before China became a significant competitor in the industry. Before, well, the Canadian dollar 10 years ago, I forget where it was, but there'd be lots and lots of different things. So I wouldn't see any reason to go back much more than 10 years. And you do your analysis. If you're lucky, you get to go visit the company. You talk to the chief financial officer. You want to talk to the CFO, not the president, by the way, because the president has the chance in the annual report. He writes, or she writes, the PR page at the front of the annual report about how everything is looking fine. And you don't want to hear that. What you want to do is talk to the chief financial officer, because if you have a mathematical or a financial question, the odds are greater that you'll get a mathematical response. Whereas if you speak to the president, you'll just get bullshit or PR coming back. So CFO is the person you want to call when you make that phone call. And so with the DuPont formula in your back pocket, you calculated the ratios that you think are important and critical to the success of this company's future ROE. And so now we've got some feel for the sustainable growth of the company. As I say, it's ROE times 1 minus the payout ratio. That's what I call the investment growth rate, the IGR. So you can do that for an individual company, and now we have to say, well, how do we translate that into sort of relative value or context? And so, well, in Canada, you'd say, well, what about the TSX? I can now buy an index fund, and so I don't have to buy an individual stock unless I think it has attributes that are superior in terms of growth or price, superior to the TSX, because that's my default logic. So we need to know, for starters, what then are the benchmarks for the TSX. So what's the average ROE for a typical Canadian company? Not this year or next year, but just over the last 5 or 10 years. What would you guess the ROE is?
Probably somewhere around 10 to 15%.
Oh, that's pretty wide range, 10 or 15, yeah.
10 to 12
10 to 12, okay. Any advance on 12? I hear 10 to 12 here. 14, 15. Any advance on 14, 15? George, do you want a bid high? No? Yeah. No? 14? No? Okay. Well, the average recently has been 14, but before that it was lower. So the longer term average seems to be stuck around 12. So everybody's right. But the 10-year average, I think, is almost spot on 12. There was a time frame when it was running higher. That was when the banks, of course, were 30% of the TSX and, earning obscene profits, at least according to the politicians. So then it was a little higher, but 12 is about the right number. So, and what's the payout ratio, the dividend payout ratio, approximately, for the whole mass of the TSX? So that includes banks that pay out reasonably sized dividends, utilities, companies that are in the resource sector that pay out none. Ballpark, what would you think the dividend is? Our payout ratio?
Maybe 20%?
Yeah, it's a bit closer to 30, 33, something like that. It's, maybe it won't grow as much over the next couple of years because the banks won't be able to raise theirs because they have to rebuild capital, but let's say about a third. So the investment growth rate, the return we might reasonably expect from a TSX-listed company today would be 12% times 2/3, what's that, 8%, plus the dividend yield, a couple of percentage points. So we're looking at maybe 10.5%, maybe 11% would be what I call our investment growth rate, expected return from buying an index fund. And so, as I say, when we're looking at individual companies, we have to say, in what way is this better? So our expected return from an index fund might be 10.5%, 11% over the long haul. The next thing we have to do is say, but how much do I have to pay for that? Again, my benchmark is not just, how much growth will I get, but what do I have to pay? And for the TSX, well, on normalized earnings, anyone want to hazard a guess on that? What's the PE ratio right now? Actually, this is too much to do in your head maybe. The price to book of the TSX right now is almost exactly 2 times book. And if the ROE is 12%, can I derive from that a normalized PE ratio? Okay, Jeff. 16, 16.6, I think. But I had the benefit of a calculator, and I had the benefit of thinking about it earlier. Yeah, the price to book and the ROE is really all you need to know, because the normalized earnings, if you want to go the long way around, is to take book value per share times your ROE. So book value times 0.12, and that gives you normalized earnings. Right? And it's not this year, next year, last year. That's just sustainable earning power. The price to book is 2, and so we know we have to actually pay twice the book value for those normalized earnings. And so actually it's 2 divided by 0.12, and that's where I hope we came up with 16. There we are. It's validated by Jeff. Okay, so the numbers are good. So now we got the 2 parts of the parameters here. So what can we do here? Well, here's my layout. Investment growth rate schematic. Here we are. And so, here we are. The vertical axis is your expected return, the IGR, investment growth rate. And so as we go up, we're getting higher expected return. From left to right is how much you have to pay, the admission price, the PE ratio. Okay? And right in the center, for our purposes, for this discussion, that's where the TSX is, right? So it's around 11%, 10.5%, 11% on the vertical axis, and around 16 and a bit on the horizontal axis. So when we analyze companies, we can do our own little company-by-company analysis. We do our own IGR calculation based on the ROE, 1 minus the payout ratio, whatever. The PE ratio, same kind of process. And we can plot all of the companies anywhere on this matrix, right? Trick question now. Which quadrant would you prefer to have most of your stocks clustered? Emmanuel? Yeah, quadrant 1, because you're getting, this is the best of both worlds. You're getting higher expected return, and you're getting it at a discount, based on your calculations. Now, the market obviously has access to the same statistics, so the market is thinking you got the numbers wrong somehow, but that's where your judgment comes in. But yeah, preferably you want to be in quadrant 1. Quadrant 3, maybe. Now, we're getting back to the intellectual property part here, because if they do have a superior return on equity, you say, I'm willing to pay something of a premium on that, that right-hand column, a right-hand line, rather. And so here you could actually draw a line. You could plot a line that had maybe what I would call a 5-year payback. You could say, I'm willing to pay a premium PE multiple such that the premium growth will recapture the premium I paid in 3 years or 5 years or whatever. Now, like lots of computer things, when the numbers come out to 2 decimal places, they take on a life of their own. And obviously, 3 years, 5 years, neither of those are the right answers. But somewhere in that ballpark, you may say, I'm comfortable with paying something of a premium for that kind of incremental growth. For sure, though, that some answers are wrong. If the answer comes back and you have to have 50 years of superior growth to pay you back that premium, you say, I don't know what's going to happen, other than the fact that in 50 years I'll be really, really old. But I'm not going to wait that long. There's too much margin for error. There's no downside protection, so on and so on. So this is a really good way of kind of categorizing companies. As I say, you can decide whether you want to say 3-year or 5-year payback. And you'll quickly learn if you start putting this into a computer program. A little bit of tinkering in any of your assumptions, and you can flip-flop from a 3-year to a 10-year payback, no problem. So you're not so much interested in the exact number. You're interested in almost backward calculating, saying what is implicit in today's stock price in terms of either profitability or payback. And you do it that way, and then you say, I don't feel comfortable with that assumption. I'm going to move on. There's lots and lots of stocks on the exchange. I don't have to buy them all. And so quadrant 3 is growth at a reasonable price. But here we have a statistical way of determining what is a reasonable price rather than just fudging the numbers so you can justify owning anything. Quadrant 4, do you want to own anything in quadrant 4? Well, logically not. You seem to be paying a high premium PE multiple for less than average growth. But I don't know, breakwater probably would fall in there if you just put the numbers in. And then you'd have to say, well, I guess, this model doesn't work very well for resource stocks. And it doesn't. And in fact, most value investors, I'd say many value investors own relatively few resource stocks because it doesn't, the ratio calculations and things of that kind don't work well with resource stocks because it's a function of macroeconomic stuff and a function of net asset value and things of that kind. So quadrant 4, you need to have a special reason, to own a stock in that category. But 1 or 2, I'm sure you can come out with. How about quadrant 2? Yeah?
I guess it'd be similar to investing in quadrant 3. While the growth is slower than 1 and 3, you're at least getting a discount for it.
Yeah, you could actually calculate a payback the other way, and now you'd say a longer payback is good because you'd say, this is a below average company. I'll agree that, in terms of expected return. But the PE ratio, the discount I'm getting is so deep, I'm willing to live with that. Because it's not that bad a company and there'll be a mean reverting process going on. That RDM, for example, might fall in this category. It has an indifferent history, obviously. So the IGR, the expected return, isn't going to be all that great. But it's so cheap. You're way down on this vertical axis that you might say, I'm willing to live with that. Exactly. Yeah. The value traps occupy quadrant 2. So if you have a lot of stocks in that quadrant, you might want to just double check whether or not you're just blindly buying, everything that's statistically cheap and you finished out with a lot of metal bashers in southern Ontario because, Windsor is full of automotive parts suppliers trading at a discount to book value. I mean, you don't need an MBA from Western to learn that. So that's what happens in quadrant 2. So, but this is, I think, a neat way of categorizing. And not just for you as the investor. If you're monitoring someone else's investments, the reason I have this is because 40 years ago almost, when I was at Confed, we managed money for American Airlines Pension Fund. Not for the U.S. employees, but for the Canadian-based employees here. So it wasn't very big. And because it wasn't very big, the chief financial officer of American Airlines would come once or twice a year just to do a review. And of course, he was at a big disadvantage because he didn't know any of the Canadian names or stocks. I mean, so we could have told him anything. And so he said, no, I want you to categorize your portfolio in this manner. And so I can see, you guys say you're value investors. So I expect to see a clustering in quadrant 1 and maybe a few in quadrant 2, maybe a few in quadrant 3, with a short payback. But he, without knowing anything at all about the companies, was able to see whether or not we did what we were saying we would do. And then he would say, okay, let's pick a name and ask us to bring the annual report from the research files to see whether or not we'd actually cracked open the annual report and done the little handwritten scribbles and calculated the ratios and stuff. Because, you can very quickly put together a matrix like this with no human input. You just download the stuff from the computer. And so he wanted to be sure that we were in the right quadrants and that we'd actually done homework to correctly categorize them. So it's useful for you if you're doing research analysis. It's useful for you if you're monitoring someone else's portfolio and you don't really recognize many of the names. So that's the, as I say, the IGR. Again, back to the intellectual property aspect and patent protection. A lot of companies claim they have that, and I'm sure these RDM guys do and what have you. But I guess my reaction to that is if you have something that is has intellectual value but isn't on the balance sheet, if they say, well, look, we have all these PhDs that have been doing research for years and years and years, and so they create all kinds of value for us. We don't patent it because it would be competitively foolish. And so my reaction would be, well, that sounds good. So you must have an above average economic rent, right? Because you've got all of this unrecognized assets on the balance sheet, so it's not in your shareholders' equity. So your return on equity should be notionally overstated by traditional accounting methods. And if you go through that logic, at that point, they're usually going to get fidgety and say, well, next year the economic rent will come through. A lot of companies, back to Bill Gates' comment, a lot of companies with legitimate technology and all kinds of neat stuff don't make meaningful amount of money. And so as an investor, you say, well, that's interesting, but I'll pay for tangible evidence of profitability. And as a value investor in particular, you say, I like to go back 5 years, 10 years to see when things are good, how good can they be, and when they're bad, how bad can they be. And so I would argue that if the intellectual property really has value, it shows up in the pre-tax margins because that R&D has been expensed in the past because of the research department. It was an expense and not an asset. So if their ROE isn't above average, then I'd say they don't have any defensible intellectual property. And that's why you might prefer to go back to home capital and saying lending money to marginal borrowers is a much better investment decision than going with high-tech stuff, along with Bill Gates. So, and then that's why, again, breakfast, George was asking me about BRIC countries, emerging countries. Do we invest significantly in emerging economies? And I'm persuaded by the studies I've seen that say there's no correlation between GDP growth and stock market returns. In fact, there's just as good a likelihood that you'll make significant returns from the stock markets of mature economies as from rapidly growing economies. And so it's the same logic there as why you don't want to invest in growth stocks, because you're paying today up front for things that may or may not unfold. Okay, let's, as I say, a handy categorization. Let's just quickly, though, look at maybe some sort of behavioral aspects, and then we'll have time for Q&A. Slow them down a bit. Let me get it this way. Here we are, yeah. Because at this point you may think, well, certainly the way I'm describing it, let me get the title there. You see. The way I'm describing it seems very mechanistic. I mean, anyone can stuff the numbers into the computer and do that little program and categorize stocks. So what's so tough about being a value investor? Well, one of the problems is that it doesn't work all the time. And this is for the Canadian market, and this is the big caps. This is the TSX Composite, and this is for the small caps. This is the BMO Small Cap Index. And they're plotting the performance, or the rate of return from value stocks versus growth stocks within the index. So they're not plotting whether or not the market is going up or down. They're plotting within the market, is growth hot or value. And when the line is going up, growth stocks are on a roll and vice versa. And so you'll see in the overall market, and they go back, a fair distance now. We're looking back to 1980. There was just a parabolic increase in the enthusiasm for growth stocks, pretty much culminating in the spring of 2000. And so that contrarily meant that if you were a value investor, you couldn't figure out what was going on. I mean, the market index was just going from strength to strength to strength. Everyone else seemed to be making money, and you weren't making any progress at all. And it got, as I say, parabolic. And so by the time we got to here, the Nortel represented 30% of the Toronto Stock Exchange Index by weight. JDS Uniphase was up there. So, I mean, it was no longer a diversified portfolio for sure, but it was certainly a pretty scary place to be if you're a value investor, and is probably not compatible with long-term employment if you were working anywhere except a value shop, because no value shop, you can be confident, was getting new clients during that time frame. So then, of course, you have this precipitous decline, and when value has become back in favor, and we've seen when it's going down, that value is the place to be. So on balance, for most of the last 10 years, value investing has proven to be preferable within the large caps, and also a little slightly shorter time frame within the small caps. So I guess there's a twofold message here. One is value investing works over the long haul, but there are extended periods when it's quite scary for your career prospects, when value investing just doesn't seem to be working, and it's quite extreme. This is obviously the most extreme it's been in the last, probably last 20 years. But clearly, there's, you have to have some recognition that just because you're a value investor and you've done all the homework, they're not going to start working for you the day you buy them. Now let me see here. So that really brings me to another, I suppose, behavioral kind of issue, and that is, well, why does value investing persistently work? Because theoretically it shouldn't. You know, if you're an efficient market hypothesis, you'd say, well, you know, it shouldn't be possible to consistently exploit a relatively simplistic phenomenon like small cap or value, and yet that persists, and certainly in small cap. And here, perhaps the best illustration I can give you, at least for the small cap part of the value phenomenon, is the lack of research coverage. You'll see this is again from the TSX, and if your market cap is less than 50 million, excuse me, you have, well, 1 or 2 analysts following your company. If your market cap is in excess of $1 billion, you have somewhere between 14 and 15 analysts. So if you're a $1 billion market cap company, then when you have a quarterly conference call, you know, the lines are jammed. When you have the Q&A at the end, there's a queue of people waiting to ask questions. As soon as you've released your earnings release, there's a whole lot of brokerage firm analysts fire off all of their emails instantly to their institutional clients. So you got pretty instantaneous reaction to the price. If you're less than 50 million market cap, and particularly if you're a value stock less than 50 million market cap, you have to call the analyst because they don't return your call. You can imagine nobody has written anything on that RDM Corporation for the last several years. I found one, I think, 2006 from Sprott, as they were then known, which is now Cormark, and that's the last research report. Which doesn't prove that it's cheap, of course, but it does prove that it's neglected. And in fact, there's I'd say a body of opinion. There's a professor who was at Cornell anyway, called Avner Arbel, and his belief is that the small cap phenomenon is in fact misplaced. It's neglect that you're being rewarded for. And so he says, obviously, there's a high correlation between small and neglect in terms of institutional coverage, and so that's why people think they're being paid for doing small cap investing. But he says that's not the phenomenon, it's really neglect. And he argues that it's better to own a neglected large cap stock than a highly followed small cap stock, because the phenomenon that you want to capture is lack of research coverage. Now, you could argue, if that's the case, then maybe there is no free lunch, because I have to do all the extra homework. You know, if I want an opinion on the Bank of Nova Scotia or Canadian Tire or Shoppers Drug Mart, there's dozens of brokerage firms following that will send me stuff, you know, at a moment's notice. If I want to have an opinion, or I'm trying to form an opinion on Danier Leather, RDM, Liquidation World, you know, nobody will admit that they follow the stock anymore because they recommended it at $6 and here it is at 50 cents. So you're doing your own homework, and I guess arguably, you could say, well, then the market is efficient. You know, I have to be compensated for the time and effort and stress associated with doing my own homework, and that's what I get paid for, is overcoming the neglect factor. So I don't know, but I guess I'm willing to go along with that thesis. But more important, I think, if you're looking for investment research positions, I think small cap and value is the place to be, because it's intellectually so much more interesting and fascinating than to be the 15th analyst following Shoppers Drug Mart. Particularly if you think back to that IGR quadrant, if you're following a large cap highly researched company, essentially you're arguing about nuances about where it is on that quadrant 3, whether the payback's 8 years or 9 years, effectively. Whereas if you're following small cap and value, boy, you've got everything going for you because you don't have any competition. It's intellectually challenging, or interesting anyway. And you get to visit companies in hotspots like Kitchener-Waterloo and Windsor, where you don't have a lot of other traffic ahead of you. So with that thought, maybe, George, I should finish, and we'll have 10, 15 minutes for Q&A. Okay. Thank you. Yep.
So, I've always been personally, that personal bias has been to always be a little skeptical of small cap stocks, just because of that same reason, that the neglect and the lack of coverage. Now, that's on a personal level, in that my investment size is pretty small. Like I'm just, every time I hear someone come in and they have a large fund and they do small caps, after you get over the neglect barrier, then you still have the liquidity barrier, which is to get in and out without really moving it. So after that's all said and done, and plus the weight factor, so after that's all said and done, like when you compare investing in small cap and large cap, why is it that you love small cap so much?
Well, I think my preference for small cap is largely intellectual. And as I say, it's more interesting, and I had no great sort of personal or professional interest in being the 15th person following the large caps. But I think there's lots and lots of studies around the world over different time frames, different geographies that show that a really simplistic analysis, and all they really do is just rank from the largest cap to the smallest cap, break them into quintiles or deciles or quartiles, and just say, we'll run with that. Effectively, they're saying, we'll run an index fund of each quartile or quintile, and we'll rebalance once a year. Almost without exception, it's the smallest cap quintile or decile that comes out ahead, and that's with no additional research. So in my professional career, I guess, I've tried to be sure, first of all, to capture the small cap effect. So we run widely diversified portfolios, 60, 70, 80 stocks. So that also, to some extent, addresses the liquidity problem, because we say, it's a bit like going to the market with a long shopping list and saying, I don't have to buy pineapples today, I just need to own some fresh fruit. So whatever looks good and is cheap, I'll use that in my ingredients. And so if you have a long list of potential candidates and you don't worry about having a 2% position in each one, then to some extent you address the liquidity issue, because you just quietly and slowly accumulate over time. And you look back and say, how on earth did I get 200,000 shares of whatever, Danier Leather? And you did it a little bit at a time. And that's something you can do if you're in a professional investment shop, because you have a full-time trader who's on the desk, whose cost is being amortized over a whole lot of other portfolios. But as I say, I'm, I guess, impressed most by the fact that the US, Canada, the UK, Australia, all of them pretty much uniformly confirm that if you do small cap and don't mess with it too much, then you get a superior rate of return. You get a little more volatility, but I think the Sharpe ratio or whatever equivalent says that the incremental volatility is less than the incremental return. If you're small, though, and you can only own 4 or 5 stocks, then I can see why that might be an argument for not doing small cap, because you might finish out with a 4 or 5 out of an entire universe that are not, in fact, the big winners. Because you have to remember, the stock market or other participants have access to the same information, the database that you have. So you haven't discovered something no one else has discovered when you come up with like RDM or Danier Leather. That information is readily available to anybody with a screen. So you have to decide, what do I bring to the party to make it, what you want is an unlevel playing field tilted in your favor. And my reaction has always been, in the big cap category, I'm competing against big guys. So why would I want to go in a bike race against Lance Armstrong? If I got to play against Lance Armstrong, maybe chess would be an unfair advantage. So similarly, large cap, I honestly can't come up with a defensible argument as to why I should do better, risk-adjusted, consistently, than everybody else. Because I'm not competing just against you or just against you. I'm competing against thousands of other people who are all working hard and are smart. And so, with small cap, I think the small cap stocks are inefficiently priced. So you could say, yeah, but they're just 50-50, they're inefficiently overpriced as underpriced. And I guess that's true, but then I'd say, but there's two reasons. I guess my final fallback argument would be there's two reasons why a stock is small cap. One is because it's inappropriately priced and it should be big cap. And the other is it's doomed to be small cap. It's a value trap, or it's just an industry that is only small cap. So at least you have, well, I don't know what the percentages are between those that are doomed to be small cap and those that are unrecognized opportunities. But I know that, there has to be a split. You go to the big cap guys, and now I'm a little nervous because there's two reasons to be big cap. One is you're legitimately big cap. And in the old days I could have given you the names GE, IBM, Eastman Kodak, whatever. But anyway, you're legitimately big cap, or you're really a small cap company that's inappropriately overpriced. And again, I don't know what the split is, but I know that in the big cap guys there's torpedoes. In the small cap guys there's hidden gems. So if I'm going to do my homework, I think I'd rather work in the hidden gem quarry than the unexpected torpedo ocean. Yeah.
You mentioned that you think you have an advantage in playing small caps, but do you find at times that the competition in that space are often focused on growth, so the companies you're speaking with aren't pressing issues that are supporting or taking steps that might appeal to the growth investors versus the value investor in small cap?
Yeah, you're right. Many, or if not most, small cap investors and professionally run portfolios are oriented toward growth, because I think the assumption of their customers or their clients is that's what you're looking for. You're looking for the next IBM, the next Microsoft, while it's still in the junior phase. And we consciously say, well, we're not interested in those kind of companies. So we do buy, though, companies that have gone what the Brits call X-growth. And I keep coming back to RDM. You can remember it used to be a $6 stock, and that was when it would have been in many people's small cap portfolios, because it's growth oriented back then. Now I don't know whose portfolios it's in right now, because it's disappointed. So now it's of interest to us. But again, that's why we're widely diversified, because if you only own a few stocks like that, after 3 years you'd say, man, this is a dog, it's not going anywhere, and you kick it out, and the next day, it'll get taken over or whatever. So you need to have enough diversification so you resist that temptation. And also we have, I guess you'd call it a clientele effect. Our clients by and large know that we're value investors, and so they've said, mentally and emotionally, that's the category they want to be in. And so they expect us to have a longer time horizon, and they don't really expect us to have a growth orientation or to talk. When they ask us about why do you own this stock, we don't talk about new products and potential technology. We talk about low price to book, low EV to EBITDA, strong balance sheet, the sort of things that would resonate with a value investor. Yep.
The instance you mentioned with Vertec where you actually suggested it to an acquirer, is this something that's happened before? I mean, I can remember in the paper when Phelps Dodge had this capital actually hired an investment banker to try and sell them. And personally, I own Sandvine shares in a stationery company that we were presenting to Ericsson, and we were trying to get them to say it was a good idea. But is this something that you've commonly done, or was Vertec a one-off?
Well, Vertec was a one-off in the sense that it happened so quickly, and it happened so, frankly, unexpectedly. I mentioned it to the guy. It was a laser-based company, same business in the U.S. in Boston, called Stocker Yale, and they had operations in Canada, in Montreal, and they seemed to have complementary businesses. They also had operations in Germany. I frankly thought they might do a bit of a joint venture, share resources. So, and that's why I brought it to his attention. But I guess this is the difference between American and Canadian executives, because he asked me to call them just to give a sort of introduction, and went up to see them the following week, and then called me and said, man, this is really great. I think I'm going to make a takeover offer. I said, I wish you hadn't told me that. And he did. And Stocker Yale at the time, had a qualified financial statements. I mean, the auditor had said, we aren't sure that these guys are going to be around to the end of the year. And that's why I never expected him to launch a takeover offer, because he didn't have any money. And I said, well, what are you going to do for money? He said, I'm going to borrow it. And as I say, that's an American entrepreneur for you. And so he got the ball rolling, but in a bid at 70 cents or something like that. And it was ultimately outbid by Gerber Scientific at $1.05. But yes, and our logic is that if we like a company because it's great statistical value, an acquisitor should find, who's going to buy the whole thing. If it's trading at 6 times EV to EBITDA, 5 times price to cash flow, and we're buying 100,000 shares, somebody who plans on buying the whole company should be intrigued by those same ratios. So we frequently, that with limited success, we frequently suggest to people that here's an attractive takeover candidate. Because a lot of small cap companies are in fact probably better suited to being a division of a bigger company. So if you can get the bigger company, and the bigger companies of course have deep pockets, so they're willing to pay what would be an extravagant premium. And so, well, La Senza is an example, Future Shop, where they had strategic advantage because they had leases in all of the prime shopping malls. And if the big US guy had tried to come to Canada, they could have done. They had deep enough pockets. But it was cheaper and more effective for them to buy somebody and instantly get access to the Eaton Centre and things like that. So, yeah, once we've got our position, we are not shy about suggesting to people that they do a takeover, which is why the OSC called me, because they thought it was a remarkable coincidence that we bought these shares of Vertec, and a month or two later, they're the subject of a takeover offer. But by the time we bought it, that was never in my wildest dreams. It was a coincidence that the company actually was acquired by it was attacked by the management of a company that I'd seen 2 months later.
Do you have any rules or ways to identify value traps? How do you protect yourself against?
Identifying value traps is almost impossible by definition, because when you buy into them you don't realize that. I guess management to some extent is a factor here, and if when you visit them regularly, their favorite topic, and their growth potential and whatever changes, and you say these guys don't have a consistent vision of where they want to go, then that would be one reason to say, I think I understand why they don't create value, because they don't stay long enough on any one particular theme or thesis. Another one would be if they make what we would consider to be sort of dysfunctional, overpriced acquisitions. Although usually the problem with that is that you read about that in the paper when they announce it, and they dramatically have overpaid. GSI Lumonics is one I remember, which was again in the laser business. Big cash, well not big, its big attraction was its cash-rich position. And it was always, I guess, nervous about being a takeover victim. And so one day we woke up and the newspaper said they'd made what we considered to be a dramatically overpriced acquisition. And so all the cash was gone, and to acquire something that we didn't think was, attractive value. So it went in a way to being a value trap, because it's no longer cash rich. It's just now an overpriced acquisitor. But that one, by the time you see that, it's too late. Although we did at that time just decide, the original thesis is gone, and it's time to move on. Yeah.
I'd like to explore the topic of investing in companies that are losing money. When you were discussing RDM, you kind of alluded to the biotech company and take a look at the burn rate.
Yeah.
Is that to say that if they've got a certain amount of cash or assets on hand, that you look at exactly how long they have to go and whether you think they're going to be able to turn around in that time, or is there a bit more to your heuristics when evaluating these companies?
Well, the starting point would be a simplistic one, cash divided by, and then you have to decide not just the most recent quarter times 4, but what is a reasonable burn rate. And from biotech companies, they will have a history that you'll be able to determine. And so for them, you probably wouldn't do much more than that. Then you would look at the portfolio of the drug applications that they're working on to try and decide, are there any potential blockbusters in there, which is pretty tough to do from the outside. But for a biotech company, yes, I would be inclined to say you just simply divide cash by normalized burn rate, and if it's less than 2 or 3 years, you'd say the meter is running against me. For other companies, you probably would want to go another step, because if it's a resource company, for example, spending money up front to get deployed, to build the mine, to build the workings, then that's really what you expect them to do. In fact, that's why they raised the money in the first place, was to get a productive mine. So there, you wouldn't be as simplistic. You just monitor from time to time to be sure that the thing wasn't going over budget, or being the time frame wasn't overrunning. But for some situations, yes, they clearly have a legitimate reason to be burning cash, and you just want to be sure that they can complete the project. Some companies, again with small cap resource companies, sometimes they shouldn't wish what they get. One we owned was called Dynatech, and they owned an Ambatovi mine on the mineral deposit in Madagascar. And for them it was huge, and it was going to cost billions and billions of dollars to develop. And they were a small cap company, so clearly they couldn't do it on their own. And so, they started looking around for a partner. And it's tough to know who has the stronger negotiating position. The guy that owns this highly prospective mining resource, or the guy with the deep pockets, because the deep pocket cash-rich guy knows that you can't do it, unless you have to do a deal sooner or later. So in the end, Dynatech was taken over, I think, by Sherritt, because it was clear they couldn't facilitate the resource on their own, but that was always right from the beginning. And so that was something where you said, I don't know what the exit strategy is, but they better have one, because I know for sure that they have not the ability to raise multi-billion dollars. Or they could issue more and more shares, in which case you say on a per share basis I'm going to be so diluted that the value of the mine per share is much less than the denominator I need to use 5 years down the road is much bigger than the denominator I'm using today on a per share basis.
Sorry for pressing, but what about a company like RDM, which isn't like that at all?
Yeah.
They're a going concern. They don't need a large investment in cash to retract it now.
Yeah, you own it, I think, for 2 or 3 years, and you check with that kind of time frame in mind. Let's say they're cash flow break even, so you don't worry about them losing it. You hope that maybe they become a division of a larger company, that somebody acquires them because they have a customer base in place, name recognition, machines and equipment that are part of the industry standard or whatever. Because if they haven't made it in 2 or 3 years, in that industry sector, it's probable that the decline rate of check usage, will offset the rate at which they're gaining market share. And so there, probably the technology change is as important as the cash. Because we've had a couple of bad experiences with the technology change for the worse is like hockey stick in reverse. We own a company that traded below cash value per share. It was called Concord Camera. They make those little disposable cameras, that used to be at the supermarket checkout. You buy them on impulse. You're going to a party or a wedding or a baptism or something. You realize you don't have a camera, so you buy one of those on the way. Quality of the pictures isn't great, but it's good enough. And they, as I say, traded below cash value per share. And at the time, this is 6 or 8 years ago, the early cell phones had cameras in them, but the quality was really poor. You couldn't see the gender of the person you were photographing, never mind who it was. So we thought, it will come in, but these guys have a cash cow, they can run it. Well, if you think back, cameras in cell phones gained traction, they got more pixels, and they became essentially ubiquitous. And it increased slowly, and then it suddenly shot up. And so now I don't think anybody, if you go to the supermarket today, I don't think you'd see those disposable cameras. So, the transition is real hockey stick, and in that case, it didn't matter. Well, you see, the scary thing then was they started making acquisitions, because they could see the writing on the wall. And they went out and bought, I forget what, a DVD distributor or something like that. So, management starts getting nervous, and that's not what you want if they have a lot of cash on the balance sheet.
The last question, because we're running out of time.
Yeah.
On the liquidity side for these small caps companies, do you have a general rule of to what percentage of the company you feel you can liquidate comfortably without it really drastically changing the price?
No, we don't. The compliance people at our shop do. And they send around this report from time to time, and it shows, we own 380 trading days worth of this and 500 trading days worth of that. With small caps, it's back to the liquidity question. And small caps in Canada that trade on the exchange, they trade a few hundred shares a day, and then there'll be a block will trade, 100,000 shares. And then they go back to trading 200 shares a day. And the reality is, I guess, if you have an institution, with a trader, they will call around the brokers. They'll look back on the quote machine and see who last did an institutional-sized block trade, and they'll call that broker and say, does your client, on the other side, still have any more stock, or does he have further appetite? And then they'll get together and we'll agree on a price, and the deal will be done, and then you go. But then, as I say, the compliance people are looking at this 200 share a day kind of number and saying, you got 5 years ownership of Danier Leather, And in that sense, we do. But you wouldn't dream of ever trying to sell it 200 shares a day. And so the liquidity, it's one of those things which is statistically correct, but practically, not useless, but practically irrelevant. We almost always find a block buyer or a block seller. Yep.
Bob, just my last question, I guess. What's the biggest lesson you learned in your investment career over the last 40 years?
The biggest lesson I learned, oh boy. It's tough to believe when you're this young, but patience. And humility, I guess, in terms of humility, not on the personal level. You can be as obnoxious as you like in your interpersonal relationships. But I mean humility in the sense of knowing what you know and don't know. And knowing what you don't know. And there's that thing about, I forget the definition about ignorance is not knowing something, and stupidity is not knowing you don't know something. And so humility is to know the difference between ignorance and stupidity, because particularly in the value sector, the ones that go up for reasons you didn't dream of. The ones that don't go up, are a big disappointment. And your real danger then is hindsight bias, because you look back and say, damn, if I'd done more homework, I could have spotted the winners and the losers. I could have put all my money in Vertec and none of it into liquidation world. And the truth is, you can't. So that's why diversify. Thank you, folks.